I have a few tips for you that I wish I had known when I started investing, or things I see in 90% of people in my investing community that stopped them from investing successfully. We're not listing the classic tips here that I already made a video on, like just get started, use the compound interest effect, set up a savings plan, but rather some unconventional tips I worked out together with other investors that you can use today that will speed up your investing journey, boost your returns, and reduce your stress. Let's start with the first tip, which is get an overview of what you can actually invest in. It might be the case that you feel like every week a new Instagram reel or TikTok is dropped into your feed with a hot new investment tip or a new asset class with which you can get filthy rich. First, it was technology stocks, then it was real estate, then crypto, then NFTs, and now with a potential lower economic growth and recent increased interest rates, different interest rate products such as bonds. Don't let the large number of ways to invest your money confuse you. First, get an overview and then consciously commit to certain asset classes and then ignore the others. It'll always seem like the grass is greener on the other side of the fence. Try to exercise discipline here and concentrate on the few asset classes that interest you, such as stocks in the form of ETFs. Ideally, you should also get a rough overview of the entire investment universe that exists. This will help you to correctly classify different investment opportunities that come your way during your investing journey. I'll be making a video covering most asset classes, whether classic or exotic, and link it in the description for you. By the way, if you like these kinds of videos, then you might want to hit the subscribe button so your finances are taken care of. The next tip is something that many people think about for a long time, namely the choice of a brokerage account. However, the choice of a brokerage account doesn't actually matter, at least not if it keeps you from starting to invest for a long time. In the past, lots of friends have asked me, hey Sean, you know finance, what's the best broker, so where should I really start with my ETF investing plan? Usually I then just give people one or two names depending on what country they're in. The main thing is that they quickly open a brokerage account and start investing. But it often happens that when I ask a few months later, how's your investing plan going? People say, I'm still comparing brokerage accounts. There was a lot to read and that wasn't really clear to me. And then there was something about crypto and then about fees and stuff. So I put it aside for now. If choosing a brokerage account makes you procrastinate, then it's definitely a lot more harmful than choosing the wrong brokerage account. Right now, the brokerage and investment account landscape in most developed countries is so good that you can hardly do anything wrong anymore. In the worst case, you simply pay a little more for your investments, but that won't bankrupt you. In addition, with most brokerage and investment accounts, you always have the option of carrying out free investment account transfers. Then you can simply have your investments transferred from one investment account to another. The whole thing is free of charge, and you can thus correct mistakes that you made in the past very quickly. Therefore, my tip is to go to a brokerage comparison tool. A good example will be one we made on the Sean Can website, which you'll find linked in the description below. Just choose a provider there that suits you reasonably well and then open a brokerage account there directly and start. If you see later better conditions elsewhere, you can always transfer. Okay, so we now have our brokerage account, but now comes the next big hurdle, namely choosing the right ETF. But choosing the right ETF doesn't matter either. What's a lot more important than the decision of which ETF you want to invest in is the overarching decision of how you want to invest. So the decision about your investment strategy. For example, if you've decided to invest actively, meaning actively in individual stocks, in active funds, or in sector ETFs, then this is a completely different strategy than saying I want to invest globally diversified in ETFs. This choice of asset class and investment strategy is much more important than the decision on the individual products. And that's because the difference between individual products is often minimal. Let me give you an example. You have decided to invest globally in industrialized countries. So you want to cover this, for example, via an ETF that tracks the MSCI World. If we take a look online, we see that there are now 159 ETFs on this MSCI World Index. Choosing which one is the right ETF here can quickly overwhelm you, because ultimately these ETFs are largely the same. They all track the same index, have more or less the same stocks in them, with almost the same weighting. That's why the same applies here as with choosing a brokerage account. Before you let yourself be overwhelmed and simply procrastinate forever, and don't start with your saving and investing plan, just pick an ETF from this list as quickly as possible. And even if you later find out it's the wrong one, you can still correct that by stopping your investing plan on that old ETF and starting a new investing plan on another ETF. Or even sell your old ETF shares and invest that money in a new ETF. Keep it simple, and if you're still afraid of making the wrong decision, then just reduce the size of your investment till you're more comfortable. When choosing an ETF, it's best to proceed as follows. First, select the index you want to replicate. Second, filter out all the funds that have a fund volume of less than 100 million. Thirdly, decide whether you want to invest accumulating or distributing for yourself. If you don't know what that is yet, then it doesn't matter either. One is not better than the other, it's just a matter of preference. Usually I recommend accumulating for beginners. And fourthly, filter the ETFs by their costs. In our ETF search, this is abbreviated as TER, which is the total expense ratio, and then choose an ETF that is as cheap as possible. You may not have the very best ETF in your portfolio, but at least you have one in there. By the way, a small note here, some of the most successful investors I know who have built millions in wealth while working just regular jobs with modest salaries don't have the best or cheapest MSCI World ETF. Back then, there weren't as many ETFs and they often just stayed loyal to the one ETF they invested in. What made them successful was that they started early to get the ball rolling and were consistent with their investing. Let's move on to the next point, which is be aware that losses are the rule, not the exception. Anyone who invests in the capital markets for the long term usually does so because they want to achieve a higher return than in a classic savings account or money account. But in the capital markets, the return comes from our willingness to take risks, and risk is usually expressed through price fluctuations. This usually means that our portfolio rises and falls regularly. Especially at the beginning when we invest and we don't yet have large profits on our positions, it can happen a couple of times that our entire portfolio is down or in the red, meaning that it is worth less than the sum of all the money we have invested in there. This is really demotivating, especially at the beginning, but be aware that periods of loss are completely normal. Here you can see, for example, a chart of a world index, and there you can see that there have been massive slumps again and again. These slumps are part of it, because in the capital market, you don't simply make 7 or 9% per year as is often stated for simplification. These figures are an average with a very large fluctuation. This means that in some years you might make plus 20 or 30%, and in other years it might be negative 30%. The average return is your reward for having the mental patience to go through it. Let's move on to the next tip, which is use interest rate products correctly. In the last years, anything that generated interest, for example, savings accounts, fixed deposits, and bonds were very unsexy because interest rates were low and you can make much more money with technology stocks and cryptocurrencies. The situation has now reversed. The development in the stock and crypto markets has slowed down, and there was even a controversial prediction from Goldman Sachs that there was too much growth in the last decade, so they predicted that in the next 10 years, stock market growth would only be 3% per year. However, many experts have started pushing back on this. Still, this has resulted in many who are toying with the idea of simply putting their money in a savings or fixed deposit account. However, this contradicts the idea of having a long-term investment strategy. If you act like a weather vane in the wind with your investments and always turn to where the wind is currently blowing from and the latest news headlines, then you probably will achieve less return in the long run. Now, although it is attractive to have 4% interest on a savings account, these were only the top offers, and in recent years, this 4% was also below the inflation rate. This means that you have lost purchasing power despite 4%. Now, I don't want to say that these products are all pointless, but they must be used in the right way for certain purposes. A checkings account, for example, is there to keep your emergency savings. There, it is available every day, and that is exactly the purpose of your emergency savings. If you don't want to invest all your money in the stock market, which would be understandable, then you can also just put part of it in a fixed deposit account. So, for example, you can invest half in the capital market in equity ETFs and the other half in a fixed deposit account. Let's move on to the next tip, which is do experiments sooner rather than later. When investing, it is super important that you know your own risk tolerance. So do you panic and struggle to sleep when the stock market drops by 10%? Or can you stay relaxed for 2 weeks on holiday without looking at your portfolio once, even if the biggest financial crisis is going on? You have to place yourself somewhere on these two extremes. If you have a great sensitivity to price fluctuations, then you should invest more risk aversely. If you are not afraid of it and are still very young, then there is nothing wrong with going strong by investing all your assets in equities. But something to note, in reality, it's not that easy to classify yourself on this scale, because when you start investing in the markets, you have no experience. Therefore, it often happens that you overestimate yourself and later find out that you panic and stress out easily when stock prices fall. That's why it's important to gain experience early on, because especially at the beginning of your investment career, you will probably have smaller budgets than later. Which means at the beginning, it's an ideal time for any risky bets that tempt you, for example in the crypto sector or in individual stocks. Then you can simply create a separate investment account for it, put a little money on it, and gain that experience. In the worst case, the money is gone, but you have learned a lot from it. However, make sure to stay strict with budgeting here. You should invest the largest part conservatively, and then you can play around with more risky things with the rest and gain experience. Let's move on to the next point, which is understand the difference between entrepreneurship and investment. If you develop a clear filter here that distinguishes between investment opportunities and entrepreneurial activities, then you will no longer be blinded by many offers. What do I mean by that? There are always coaching, YouTube, Instagram, and TikTok channels and offers from people who show you how to learn the latest and super attractive opportunity to generate passive income. For example, you might be shown how to become a real estate investor and achieve an immense return with as much leverage as possible, so using debt. They then tell you that you can simply take money from banks, build a real estate empire with it, and then collect rent every month. Apart from the fact that this image is usually always seen overly optimistically and is not as easy as you imagine, this is clearly an entrepreneurial activity. So you might decide to become a real estate investor. But when we talk about investing, meaning when you take a part of your income and invest it regularly in the capital market via a savings plan, then the requirement for this is that you can continue to work in your job and simply put your money aside to build up assets without having to change your job or invest additional time. These kinds of offers to get rich passively are everywhere, whether it's your own Airbnb business, making money with options trading, or crypto trading. Apart from the fact that with many of these things, the probability of success is probably quite modest, all of this requires you to invest your time, thus making it an entrepreneurial activity. Of course, you can then achieve immense returns versus your invested capital, but you have to invest additional time, and this of course also has its value and therefore cost to you. That's why you shouldn't compare long-term returns from passive investing in the stock market, for example with the help of ETFs, with active earned income from these entrepreneurial activities. To secure your retirement and provide for yourself in the long term, you should not be tempted to take entrepreneurial risks. If you decide to do so, as I have done for example, then this must be a conscious decision for an entrepreneurial activity and not an investment decision. Let's stay with my example. I am entrepreneurially active and therefore also bear the associated risk, but when it comes to my private wealth building, I intend to have it invested for the long term, keeping it boring and passive, just how I like it. Let's move on to the next tip, which is reduce your personal background noise. In the past, finding serious and well-researched information on the topic of finance wasn't that easy. There was hardly any content online, and what did exist wasn't that great. In the mainstream media, there was also hardly any information on the topic of finance unless it was in specialized media channels like Bloomberg and CNBC. Nowadays, the exact opposite is the case. There is an infinite amount of information on the topic of finance, both in social media and classic media. Just be on Twitter or X and you'll get bombarded with the latest news. But this can end up distracting you from your passive investment strategy. Most of the things that are published here and presented as facts are usually just personal opinions. For your own financial well-being, you can distance yourself from this and simply reduce the noise level and not consume this news in the first place. It's best to avoid distractions. If you're still interested in staying up to date, you can still read the news or listen to podcasts. I myself have a newsletter that I send out every Monday with tips to help you keep and grow your money. You'll find a link in the description below. But when you consume any content, don't let it distract you from your core investing strategy. Now let's get to the final point, which is be skeptical, even towards me. Nowadays, financial news are all about headlines. It's all about who wrote the most clickbaiting title and not about the much deeper research. This is exactly what is dangerous in the financial sector because here, like nowhere else, exists a huge number of conflicts of interest which are sometimes pretty hard to spot. A conflict of interest exists, for example, when a person says something from which they themselves then derive financial profit, without this being directly apparent. Here's an example. You run a technology fund with which you invest in very volatile technology stocks, but you are also active in public and emphasize the advantages of technology stocks and your fund in particular. You have no interest in critically presenting the financial product because you want people to invest there. Or you are a precious metals dealer and regularly produce content on topics that scare people and then simultaneously present the supposedly safe solution, namely investing in precious metals such as gold. Or let's stay with the case of this channel. We show you how to invest your money in the stock market for the long term, point out that you need a securities account or a broker for this, and then we link some offers, and then if you open an account here, we get a small commission. Always ask yourself the question, who benefits from this and how does the money flow? And then ask yourself the question, how transparently are these conflicts being disclosed? For example, we usually mark any type of link where we would receive money for a transaction with an asterisk and a footnote to indicate that money could flow here. These were some more tips that we were able to think of that are outside the norm. What do you think about it? Feel free to write us in the comments below. If you enjoyed this video and haven't watched our first video on the best tips any beginner should know when they're investing, then you can check it out in the description below. Elsewise, if you already saw that, then you might be interested in this video here to know when you can actually stop your saving and investing and start relaxing instead, using math to prove it. Thanks so much for watching, have a great day, and see you in the next video.